In 1970, the average price of an American home was $24,000. A brand new Ford Mustang cost less than $3,000. A gallon of gas? 36 cents. Today, those numbers feel like a bad joke. But this isn't just about things getting more expensive. This is about a silent, invisible tax that is systematically stripping the middle class of their hard-earned freedom. If you were taught that the safe way to build wealth was to work hard, live below your means, and park your cash in a traditional savings account, you were lied to. In today's economic climate, saving is no longer a path to security. It's a guaranteed loss. We are living through a period where the rules of money have been rewritten right in front of our eyes. While you sleep, the purchasing power of your safe money is evaporating. This is the story of how the middle class is being hunted by the very system that's supposed to protect it. And if you don't shift your strategy in the next few minutes, you could find yourself working until the day you die, regardless of how full your savings account looks. My name is Andrew, and today we're diving deep into the mechanics of banking theft. We're going to break down the hidden problem the banks don't want you to see, and more importantly, the step-by-step solution to escape this trap before it's too late. To understand why your savings account is a trap, we have to look at the hidden problem that nobody in Washington or on Wall Street wants to explain in plain English: the expansion of the money supply. In 1971, everything changed. President Richard Nixon decoupled the US dollar from gold. Since then, our currency has become fiat, money backed by nothing but faith and credit. This gave the government the power to print money at will, and they didn't hold back. Since 2020 alone, the M2 money supply, essentially the total amount of money in circulation, has exploded by nearly 40%. Think about that for a second. If you have a pizza with 8 slices and suddenly you decide it now has 12, the pizza didn't get any bigger. Each slice just got smaller. That is the essence of inflation. The hidden problem for the middle class is that while the cost of assets, like real estate and stocks, skyrockets because there's more money in the game, your wages and your savings just can't keep up. This is known as the Cantillon Effect. The people closest to the source of the new money, the banks, the government, and massive corporations, get to spend that fresh cash before it drives up prices in the general economy. By the time that money finally hits your paycheck, the price of milk, eggs, rent, and insurance has already spiked. In practice, you're paying for the expansion of the money supply with a lower standard of living. Let's do the math. If you have $10,000 in a high-yield savings account paying 4%, but the real cost of living inflation is 7 or 8%, which includes the things that actually matter like healthcare and education, you aren't making $400. You're losing $300 to $400 in purchasing power every single year. It's like running on a treadmill that's spinning faster than you can sprint. This is the savings trap. The more cash you hoard, the more you're being taxed by the system without ever getting a bill in the mail. It's the perfect crime because most people don't even realize it's happening until they hit retirement and realize their million-dollar nest egg only buys the lifestyle of someone who had $300,000 20 years ago. So, if saving is losing, what's the real solution? How do you protect yourself when the system is rigged against you? The answer is to completely flip your financial philosophy. Stop being a saver and start being an owner. The first step is to kill the liquidity fetish. Most people keep too much cash because they feel safe seeing a high balance in their banking app. In reality, cash serves only 3 purposes: your immediate monthly bills, a 3 to 6 month emergency fund, and dry powder for opportunistic buys when things get ugly. Anything beyond that is a liability. You need to view every dollar above your emergency fund as a soldier that needs to be sent to the front lines to fight for more money. The second step is to acquire tangible or productive assets. Inflation benefits debtors and punishes savers. Why? Because when you borrow money to buy an asset that appreciates, you're paying back that debt with cheaper future dollars. Take real estate, for example. This is the ultimate middle-class hedge. When inflation rises, the value of the property goes up, the rent you charge goes up, but your fixed mortgage payment stays exactly the same for 30 years. You are effectively shorting the dollar while building equity in something people will always need: a roof over their heads. Next, we have low-cost index funds. If you want to build wealth sustainably, the S&P 500 is your best ally. You're buying a piece of the 500 most profitable companies in the world. When prices go up, these companies raise their prices to protect their margins. Their profits grow, and the stock price follows. By owning the market, you're participating in the growth of the economy instead of being a victim of currency devaluation. The third step is utilizing tax-advantaged arbitrage. The only thing more certain than inflation is taxes. To beat the system, you have to use its own rules. Maximizing a Roth IRA or a 401k isn't just boring advice. It's a mathematical necessity. By shielding your gains from the IRS, you're essentially giving yourself a 15 to 30% head start over the inflation rate. In a world where every percentage point matters, you can't afford to be inefficient with your taxes. The fourth and perhaps most important step is to invest in your own earning power. The best protection against a devaluing currency is your ability to earn more of it. Inflation can eat away at the dollar, but can't touch your skills as a software engineer, a salesperson, a doctor, or a creator. As the dollar weakens, the market value of your high-level skills will naturally adjust upward. If you provide 10 times the value to the market will pay you regardless of what the Fed does with interest rates. The middle class is at a crossroads. For decades, the path was simple: save, retire, relax. But that path has been washed away by a sea of debt and devaluation. The new middle class isn't defined by what they have in the bank. They are defined by what they own. They own their homes, they own shares in global companies, and they own their time because they refuse to let their wealth sit stagnant in a sea of depreciating paper. They understood that in a world of infinite printing, scarcity is the only thing that holds value. Inflation is a thief, but it only steals from those who don't see it coming. By watching this, you've already taken the first step. You've recognized the problem. Now, the question is, are you going to keep saving your way into poverty, or are you going to start building a fortress that inflation can't breach? The system wasn't designed for you to win. It was designed for you to participate. It's up to you to change the game.